Application of marginal costing. Application of marginal costing. Application of marginal costing in bracket we have non-routine decisions, limiting factor analysis. So the key thing there is limiting factor analysis, but using marginal costing. Limiting factor analysis. Limiting factor analysis. Application of marginal costing. Application of marginal costing. Now, candidates, in the real world, in the world that we live, in this world that we live, businesses often face constraints or limitations on their resources. Resources, we say, are always limited. If you're in business, you cannot have unlimited resources. Resources are always limited in business. So businesses face constraints or limitations on their resources, be it labor hours, materials, overheads, direct expenses, land, buildings, all the assets that are required to do business are always limited. And this could be limitations on machine hours, labor hours, raw materials, or even sales demand. There could be a limit on people who are willing to buy your services or products. And in such scenarios, limiting factor analysis helps to determine the optimal production mix in order to maximize profits. If you have limited machine hours, then you have to ensure that the few machine hours you have give you the maximum output. That's why we are studying what we are calling limited factor analysis, which is a management accounting technique. It is a management accounting technique used to determine the most profitable, let me use that word, the most profitable product mix when there is a shortage of key resource. If a company is producing product A, B, C, D, and each product has a different contribution, and there is a limit to the number of hours that this can be applied in order to produce these products. So the company must have the right product mix so that the product that earns most contribution should be allocated majority of the hours. You understand? So that's what you are referring to as limiting factor analysis. Limiting factor analysis. And we are using marginal costing to carry out this analysis. You understand? Because by now you understand what marginal costing is all about. It is a valuable tool for limiting factor analysis because it focuses on the contribution margin of each product. And we know candidates' contribution is the difference between the sales value and the variable cost. So in marginal costing, we deduct the variable cost from the sales to get the contribution. And that's contribution per unit, the selling price per unit minus a variable cost per unit will give you the contribution per unit. So contribution margin is the difference between selling price and variable cost per unit, which is the amount that each unit sold contributes towards covering fixed costs and generating profits. It is out of the contribution that we pay fixed costs, and what remains is what we are calling profit. Do you understand? So, what are the steps? Let me outline the steps in limiting factor analysis using marginal costing. Step number 1 is to identify the limiting factors. Identify the limiting factors. Identify the limiting factors. And I've defined limiting factors. These are resources that are limited. Okay? These are resources that are limited. Limited resource. So, step number 1, identify the limiting factor. That is to mean, determine the resource that is in the shortest supply and constraints production. And we gave examples. It could be machine hours, labor hours, or any other critical resource. List down the limiting factors, step number 1. Then calculate the contribution margin. Calculate the contribution margin per unit. Calculate the contribution margin per unit. That is the second step. That is for each product. For each product, calculate the contribution margin per unit by subtracting the variable cost from the selling price per unit. You understand? Calculate contribution margin per unit. Step number 3, calculate the contribution margin per unit, and this is for the limiting factor. Calculate the contribution margin unit. Contribute the contribution margin per unit for the limiting factor. Calculate the contribution margin per unit for the limiting factor. That is to say, we divide the contribution margin per unit by the number of the limiting factor required to produce 1 unit of the product, and that indicates how much contribution each product generates for each unit of the scarce resource. Are you following? Yes. Then step number 4, rank the products. Do what we call product ranking. Rank the products in descending order based on their contribution margin per unit for the limiting factor. 5, allocate the limiting factor. Allocate the limiting factor. Okay? Allocate the limiting factor. That is to mean just produce and sell the products in the order of their ranking until the limiting factor is exhausted. Then ultimately you calculate the total contribution margin. The total contribution margin. Calculate the total contribution margin. Calculate the total contribution. Lastly, calculate the total contribution margin by multiplying the number of units produced for each product by its contribution margin per unit, then sum the values to find the total contribution margin. So that is the steps we follow in limiting factor analysis. You understand? So in our next session, we'll be looking at illustration. This may not make sense, but when we do an illustration, you will see how these steps are applied in the application of marginal costing in limiting factor analysis.